We're always seeing these huge economic headlines, right? GDP is up, markets are down. But what's really going on behind those numbers? What are the small, deliberate moves that actually make a country's economy work? Today, we're going to peek behind that curtain.
So, what is it that really makes a national economy tick? Is it some giant master plan announced from a podium? Or is it something, well, something a little more subtle, happening just under the surface?
Well, the truth is, it's way more complex than that. It's not about one big command. It's a world of constant, detailed adjustments. Think of it less like flipping one giant switch, and more like 1,000 tiny tweaks to the wiring, all happening at the same time.
To really get a feel for this, let's zoom in on just 1 week, the second week of January 2026, to be specific. By looking at the actual rules and regulations that rolled out in just 7 days, we can start to see how these tiny changes paint a much, much bigger picture.
All right, first up, let's talk about building tomorrow's foundation. Because before an economy can really take off, you've got to have a solid base, the actual physical stuff for it to grow on.
So what actually happened that week? India's Central Board of Direct Taxes made a quiet but powerful move. They used a key financial tool, tax exemption, and they aimed it squarely at a few very specific local development authorities.
And the ones who got this special status were the development authorities for Mussoorie, Dehradun, Kota, and Gorakhpur. Now, these are not random places. Each one represents a key area that's been targeted for a specific kind of growth, whether that's urban renewal or major industrial expansion.
And this is the whole point, right? By not having to pay income tax, these authorities suddenly have a lot more cash to spend directly on what they're supposed to be doing. Building roads, developing industrial parks, creating new housing. It's like a targeted injection of capital right where it's needed most.
Okay, so the physical foundation is getting laid. But what about the businesses that are actually going to use it? That brings us to our next theme, powering commerce. This is all about greasing the wheels of trade, especially for companies that are selling their products all over the world.
This next one is a perfect example of a tiny change that has huge ripple effects. The government tweaks something called the E-Bank Realization Certificate, or EBRC. All that is the official proof an exporter needs to show that they actually got paid by a buyer in another country.
Now, on the surface, the change seems pretty minor. Before, this certificate was missing some key tax details. But after January 13th, it has to include the exporter's GST number. That's the Goods and Services Tax ID, plus the invoice number and date. This is a brilliant little move because it directly links trade data with tax data, which makes everything smoother and cuts down on a ton of paperwork down the line.
But it's not all about tightening the screws. At the same time, some rules were actually being loosened up. Just look at this number, 50,000 metric tons. That is the new annual export quota for organic sugar. And this is a product that, before this, was actually banned from being sold overseas.
Now, this wasn't just a free-for-all. The government set up a really clear, controlled system. Exporters have to go online and register their contracts with APADA. That's the Agricultural Export Authority. Then they get a special certificate, and finally, they have to get the shipment out the door within a pretty tight 45-day window. It's a really smart way to help out organic farmers while still making sure there's enough supply at home.
And that support wasn't just for big exporters. It trickled down to small local businesses too. In that same week, the National Traders Welfare Board was focused on getting small traders plugged into the modern economy. They ran campaigns to make the tax system simpler, pushed them to join the National E-commerce Network, and promoted the Vocal for Local idea to get people to buy more domestic goods.
All right, so we've got the foundation, we've greased the wheels of commerce. What's the last piece of the puzzle? Securing the entire financial system. This is all about those invisible rules that build the trust and stability that everything else depends on.
So to get this next part, you have to understand a concept called risk weight. And honestly, the easiest way to think about it is like a bank's mandatory safety cushion. For every single loan a bank makes, it has to set aside a certain amount of its own money, just in case that loan goes bad. The riskier the loan, the bigger the safety cushion has to be.
So the RBI, India's central bank, just tweaked these safety cushion rules, specifically for loans given to companies outside of India. And the logic here is crystal clear. If you're lending to a super stable, highly rated company, you only need a 20% cushion. But if you're lending to a much riskier, unrated company, whoa, that requires a massive 150% cushion, forcing the bank to keep way more of its own money locked up.
And look, this isn't just some boring technical update. The goal here is really twofold. First, it gets Indian banking rules in line with global standards, which is a big deal.
And second, it makes sure that banks are properly protected from risk when they're lending money internationally. It's all about financial stability.
And that theme of stability and trust, it kept going. A new rule came out that requires financial firms to publicly disclose any deals they do with related parties. We're talking about their own executives or major shareholders. It's a pretty direct way to stop hidden conflicts of interest that could be really risky.
But here's the interesting thing. Securing the system doesn't always mean piling on more rules. Sometimes it's about getting rid of the ones that slow things down. In that same week, SEBI, India's market regulator, actually made it easier for alternative investment funds to operate. These are the funds that invest in startups and new ventures, so this change basically makes it faster for new, innovative ideas to get the money they need.
Okay, so let's pull back for a second and connect all these dots. We've looked at all these individual little changes in tax and in trade and in finance, but what does it all mean? What's the big picture?
When you look at it all together, in just 1 week, you can see 3 really clear strategies at play. First, you've got targeted tax breaks to literally build the cities of the future. Second, smarter rules to make it easier to trade with the rest of the world. And third, stronger regulations to make sure the whole financial system is safe and sound.
And this is probably the biggest takeaway from all of this. None of these things are happening in a vacuum. They aren't just random, disconnected updates. They are all interlocking pieces of a much larger economic strategy, all designed to push things in a very specific direction.
It really just boils down to this simple idea: small rules, big impact. The real, fundamental work of shaping a national economy happens right here in the fine print of these updates that most of us never even see.
And that kind of leaves us with one final thought, doesn't it? We just got a little glimpse behind the curtain of India's economy for 1 week. But it makes you wonder, what are the invisible rules, the tiny, deliberate tweaks that are quietly shaping your world right now?